July WTI crude oil futures fell more than 2% on Friday, testing support near $87 per barrel late in the session. The decline marks the seventh consecutive day of selling since prices peaked above $104 on May 19, as traders continue to unwind risk premiums tied to Middle East supply disruptions. The primary catalyst behind the sell-off is the rapid shift in expectations surrounding a potential ceasefire between the United States and Iran. What began as speculation has quickly evolved into active negotiations aimed at reopening the Strait of Hormuz and restoring commercial shipping flows. While key issues remain unresolved, including security guarantees and regional stability arrangements, the market is increasingly focused on the direction of the talks rather than the final outcome. As long as negotiations continue to move forward, traders are likely to keep removing geopolitical risk premiums from crude prices. At the same time, signs of demand destruction are becoming increasingly difficult to ignore. Elevated oil prices earlier this year placed significant pressure on major importing nations such as Japan, South Korea, and India. Higher fuel costs forced consumers and businesses to curb consumption, leading to weaker than expected demand growth. Recent reports from the International Energy Agency highlighted this trend, noting that global consumption has fallen short of previous forecasts, helping offset some of the supply concerns that drove prices higher during the first half of the year. Supply expectations are also improving. The EIA recently revised its outlook to reflect the potential for increased oil flows from the Middle East, while OPEC continues to maintain substantial spare production capacity that could be brought online if market conditions warrant. The combination of loosening supply expectations and softer demand has significantly altered the market's balance, reducing the willingness of traders to aggressively buy price dips. This week's U.S. inventory report offered little support despite showing declines in crude oil, gasoline, and distillate fuel stockpiles. Refiners increased operating rates to meet seasonal demand, and under normal circumstances falling inventories would be considered bullish. However, the market largely dismissed the data as traders focused on the much larger implications of a potential reopening of the Strait of Hormuz. The prospect of additional Middle Eastern barrels returning to global markets far outweighs the impact of a single week's inventory draw. Looking ahead, both the ceasefire negotiations and weakening demand are reinforcing the same bearish narrative. Additional supply could return to a market where high energy prices have already slowed consumption growth across key Asian economies. With OPEC still holding significant spare capacity and geopolitical tension showing signs of easing, the supply disruption story that fueled crude oil's rally earlier this year is steadily losing influence. Unless a new bullish catalyst emerges, traders may continue to reassess oil's risk premium and push prices toward lower levels. From a technical perspective, the $92.50 level on July WTI crude oil has become key resistance. As long as prices remain below it, the sell the rally strategy remains in control. A break below $85 would confirm a broader trend shift and open the door to a move towards $77.50, the next major downside target within the value zone between $80 and $75. For a deeper look at data-driven analysis, price signals and forward-looking market expectations for natural gas and oil, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.